Hello, welcome back. Roblox Corp is a company that has been completely annihilated along with the rest of the stock market, especially tech. And this one is a communication services company. You will see that it has been down 82%, and today finally it's up 10%, even though they reported relatively weak earnings. We can take a look at the stock news right now, and you will see that Roblox at some point shares actually jumped 20% despite weak results. If we take a look at our dashboard here, you will see that the indices have been completely annihilated. Nasdaq is down again almost 2.5% after the inflation report being hotter than expected. And of course, this has been reflected in the stock market. And right now, instead of 20%, Roblox is actually up 10%, almost going to 11 right now. So you will notice in the max chart that the company's initial days, the first IPO was near 70, and right now is a third of that. $25, absolutely insane, and again down massively, and it's going down and down. Now, if we take a look at the report, the earnings report, you will see what happened here with the company. They reported weaker than expected results, and yeah, at some point they were up 20%. You'll see a loss of 160 million versus 134 last year, year over year, pretty much. And per share loss of 27%, which is better, 27 cents, which is better than last year's 46 cents. Now, bookings fell 3%, and FactSet consensus was for 68 million loss on 655.7 million in bookings. Ended the quarter with 54 million daily active users. That's better, up 28%. That actually matters a lot with these kinds of companies. And hours engaged also jumped 22%, which is also a nice thing to see. So Q2 started on a strong note, as you'll see. Started the second quarter on a strong note with daily active users and hours engaged up 23 and 18% respectively in April. Of course, a very, very good thing to see. Now let's take a look at the company's financials though and see whether, after being slumped so much, whether it's a potentially interesting buy right now because it's going down and down. The P ratio of the company has been, as you'll see, negative here. And the price to free cash flow ratio positive but high, as you will also see, 29 right now. And outstanding shares that have been increasing, and you will see here that 24% has been the dilution that the company has actually offered to stockholders. That's quite some actually, and this is 2021 really, it's like a year. So they have been selling stock like crazy when the prices were higher through 21 pretty much. Probably that's something that they would be stopping, I suppose, soon, because right now their stock price is very, very low to be selling all this stock. And free cash flow to total liabilities ratio, a little bit more total liabilities that we would like to see compared to the free cash flow, but we will examine that in the financial statements. 5-year revenue growth that keeps increasing, 5-year net income growth that keeps going down though, so that's interesting. And free cash flow growth that is going up, we'll see why this is happening. And debt to equity ratio a little bit elevated here. So the company seems to be having a little bit of extra debt, and of course it's not profitable, so you're looking at negative returns. That will play a role in our analysis, of course. Company is not paying any dividend too. So let's take a look at the financial statements, starting with the income statement. 312 million to 1.9, almost 2 billion here, so great growth in terms of sales, that's a good thing. And the net income of the company negative, and actually creeping up higher in terms of negativity. Almost $500 million loss for the last year, pretty much, 2021 that is. And as we're getting the new reports soon, this is going to be updated with new quarters, and it may actually already have been. Now this is Q4 2021, and yeah, this data gets updated as they are getting reported through SEC. And as you'll see here, yeah, the net income of the company even quarterly has been down pretty much every quarter. Let's take a look at the balance sheet. And you will see here that the total equity of the company has been increasing basically in 2021. And of course, this has been done through funding in terms of additional paid-in capital here, selling a lot of stock. And this is how the company has been making their assets. And this is why it's jumped 4.5 billion over here in the past year for the most part. And their equity is actually sitting at $500 million. Cash flow statement, net income again is negative, and so this becomes positive in terms of operating cash flow because of the stock-based compensation. Of course, and some change in working capital as well. This is what makes it positive for the most part, but not really profitability is the thing. So remember, stock-based compensation, for example, is subtracted from the net income because it's a non-cash expense, and this is why it gets added back to the operating cash flow. And net cash by investing activities is negative. The company is investing a little bit, that's normal. And look at this financing cash flow. Company is getting tons of debt, 1.5 billion. That's something that I don't like to see. They have a little bit of cash that they have amassed from stockholders. And yeah, the free cash flow is positive. But if we take a look at the stock evaluation tool, this is what gives us the story very, very quickly and adequately here. Because the revenue growth is amazing. We can have pretty high. Let's just go 20, 25, and 30 here. Let's just say that the company is going to be growing massively every year for the next 5 years. But take a look at the net income margins here. These are all negative. So what are we going to do here? The company is not making net income, and it's actually growing worse and worse every year. You will see here that it's in the negative every year, and last year was the worst. So I don't like to see that at all. We'll have to go like marginally profitable here and see what we get out of this one. And the free cash flow margins, I mean, we cannot use these averages because they are derived from negative net income. So we'll go with something typical like 80, 90, and 100 here. And 13% for an annual return is what I typically want to be making out of any single stock. So if we hit calculate for Roblox here, you will see that because the company is not profitable, this kind of projections here will give us very, very low values, and our high estimates, which do include income margins of 5% here, still give us $5, and the current price is 25. And if we accept that the company will eventually grow and have margins that are 10, 15, and 20, which they are very, very far from this one, you'll see that these are all negative here. If we hit calculate now, you will see that even in this situation with 20% net income margin, we are still below our current price, $25. And so even though the stock has been absolutely decimated, it is still expensive. And I would actually avoid it personally. I think it would have to go much, much lower for me to consider buying it. Or the company would have to be reaching profitability very, very soon. And this doesn't seem to be the case. Remember, we're taking a look at what the company has been doing. And they are losing more money. Lost 106 million in 60 million in Q1 versus 134 in Q1 of this year. So it is actually in a downwards trajectory here. You don't like to see that. So thank you for watching the video. I hope you enjoyed and it helps you a little bit. Let me know what you think about Roblox, and remember to subscribe and like the video. That helps a lot. And you can always become a Patreon and get access to this tool, in which you can try all sorts of stocks and projections on your own whenever you like. You have unlimited access. You can find links in the description box below, the description box of this video. Thank you for watching again, and I'll see you in the very, very next one. Bye bye.